Hey, how's it going? Bill Lethman here for Money Evolution. And in this video, I'm going to be talking about tax strategies if you're making over $500,000 a year. Now, for purposes of this video, I'm actually going to be working on a hypothetical client that's a couple making $500,000 a year and filing a joint tax return. But the ideas and the strategies and the principles that I'm going to get into here today, they can very easily be applied if you're filing a single tax return or even if you're filing a head of household tax return. Just some of the numbers and the brackets are going to change a little bit there. So let's dive in and let's take a look at our tax table here. And we can see that at $500,000 of income, they're going to land kind of at the upper end of this 32% tax bracket. That goes up to about $516,000. So I think the first thing that we need to be thinking about as we're putting together these tax strategies is the expiration of what is called the Tax Cuts and Jobs Act rate. So the Tax Cuts and Jobs Act rate went into effect in 2018 and was set to sunset at the end of 2025. And then in 2026, we're going to revert back to the old tax table, probably with some adjustments for inflation. That's if Congress doesn't enact any new laws or rules or anything. So over here on the right, one of our reference materials that we have is a quick snapshot of what that tax rate might look like today if it was under the pre-Tax Cuts and Jobs Act rate and with an adjustment for inflation there. So one of the things that I've talked about in many other videos is that this 24% tax bracket really expanded. It kind of took over from what was the 28% bracket, but that 24% bracket actually goes about $100,000 into what used to be the old 33% tax bracket. So I think the number one thing that we want to be thinking about as we're talking about these tax strategies is we want to be thinking about the expiration of that Tax Cuts and Jobs Act in 2026. And what does that look like for your income when that happens? Kind of along the same line of that is we also want to really be thinking about what is my income today versus what is that income going to look like down the road? Are you in a job position or do you have a business and that business you're expecting is going to continue to grow and your income is going to start going up exponentially where you're making $500,000 a year today, but maybe in a few years you might be making $750,000 or $850,000 or even $1 million or more, whatever that may be. So you want to be thinking about that future income and creating some way that you could create a map so you can see what your tax brackets are and how those tax brackets evolve over time. The third thing that we want to take a look at is what do those tax brackets look like when you retire? And so a lot of the people that watch our channel here, not everybody, but a lot of the people are getting closer to retirement, and especially as your income grows and you get up to the $500,000 or above pay type of income every year, and that's going to be later probably in your career. And at that time when you retire, that income drops off. That might open up for what we sometimes refer to as some low tax years. That's something that we're going to get to here in a little bit. So you want to be looking at what that income is now, what it looks like, and what bracket you're going to be when the tax cuts expire in 2026, and then kind of thinking about where your income and bonuses and things might be in the future, and then how many years are you planning as far as the retirement? Are you going to be retired in 3 years? Are you going to be retired maybe at the end of 2025 and you're going to go into retirement with year one being that first year without the Tax Cuts and Jobs Act? Those are some of the things that you want to be thinking about there. And then as you're doing that and you're creating this map, and I'm going to show you here in just a little bit what that looks like inside of our software and how we map this out, how you could do this too. But creating that future, sort of timeline is what I like to refer to that as. But what are the things that you can change? So number one, just call that change. So number one is you can change where you contribute. So there's things that you can do that could lower your taxable income right now. And so that would be primarily, that would be like traditional retirement accounts, pre-tax savings. Things like HSA could lower your income a little bit there. Some people have access to a deferred comp plan, basically where even over and above your 401k savings and things, you can save additional monies. Different companies have different rules and restrictions for that, but it's basically saying, hey, don't pay me this income right now today. I don't want that to maybe push me up into that next tax bracket. I'll take that as a deduction off of my income. They let you typically invest that money to grow it like you would your 401k plan and things. And then at retirement, depending on what the plan rules are, you can start to elect to take that money out. Sometimes it could be just in a big lump sum. They could be really careful about that because that could really skyrocket your income for that 1 year. But most of those allow you to basically spread that out over maybe 5 years or 10 years, or even sometimes even a little bit longer than that, where you can say, hey, you accumulate $1 million in that deferred comp plan, and you're going to take it out in 10 installments of about $100,000 a year over your retirement. And so again, that would be trading some of those higher tax brackets that you have today for what could be lower tax brackets in the future, if you can kind of level out that stream of income and everything, and plus provide for the fact that you no longer have a paycheck or business income coming in. So where you can contribute to that is number one. Of course, you could take and contribute money to a Roth account as well. And that means you're paying taxes today. You're not getting any immediate tax benefit, but there's future tax benefits, and that as long as it's qualified distributions, you can take money out of a Roth account without having to pay any taxes in the future. So something we've talked about in a lot of other videos is it comes down to what is my tax bracket today versus what is my tax bracket going to be in the future. So if my tax bracket today is higher, making $500,000 a year, 32% tax bracket, if I think my tax bracket in the future, even with the reversion back to the old tax rates, is maybe only going to be 28% or maybe 25%, you can benefit by taking that tax deduction right now. Now, there are a couple of things that we need to be thinking about just in the slight near future here, but the Secure Act 2.0, which was passed in December of 2022, and then they've been phasing in different elements of that Secure Act. And so beginning in 2026, for high income earners, individuals making over $145,000 per year, when you go to do the catch-up provisions, they're requiring those to go into the Roth account. In other words, you're going to have to pay taxes on that, so you may not have that ability to take that as a tax deduction any longer on that. There's also some expansion for individuals that are between the ages of 60 and 63. So for those 4 years, they're increasing the amount of catch-up. That's another way that you can control some of this income a little bit and get some money shifted over potentially to be a little bit more tax deferred. And that's, again, going into effect in 2026 there. The second thing we can take a look at, and this is going to basically be relevant if you're saving money outside of retirement accounts like 401k plans or IRAs or Roth accounts, and that is looking at the investments and thinking a little bit more intentionally about that. And so hopefully, if you're making good money, you're in a pretty good cash positive position. Maybe you're already maxing out your 401k plans and all the different options that you have there. And you start to accumulate some money in what we sometimes refer to as a non-retirement account or a taxable investment account or brokerage account or whatever it may be. But there's different types of income that those investments in that bucket can get. Things like interest income and short-term capital gains are taxed at your income tax base. In other words, any money that you make in that category is going to push you up into the next tax bracket or add to the amount to go into the tax bracket tables. But things like what we call preference items, things like long-term capital gains and dividend income get taxed a little bit differently depending on your tax bracket. Could be taxed at 15% or 20%. In fact, actually, I think the limit is just over $500,000 where you hit that 20% tax bracket, but it's still a lot less than what it would be at the 35% or 32% or whatever that may be. And also any dividend income, qualified dividends, I should say, and there's a difference there. And any long-term capital gains, they don't go into that tax table formula. So you could literally have $100,000 of qualified dividends, and it's not going to be part of that that tax table there that's going to push you up potentially up into one of those higher tax brackets there. So very important to know that and to make that distinction there. And so as we talk about that, Should probably draw this out here. And we look at the three primary tax buckets here. One of the things we want to do, and we're going to talk about as we get into the actual hypothetical illustration here, is how can we do some shifting to get this money a little bit more tax efficient. We talked about the types of investments that go into this non-retirement account bucket, but if we have money here, we might be better off in many cases, most cases probably, to shift some of that money from that non-retirement account over into one of these other categories here, either the traditional or to the Roth bucket, so that you can become more tax efficient and really kind of control that income a little bit better, a lot better. Some things we can do for that. Some plans, some 401k plans, allow you to do an after-tax contribution, and due to a relatively recent tax law change or IRS update there, the IRS now allows you to move those after-tax monies over directly to a Roth IRA or to a Roth IRA or a Roth 401k, either one, without any taxes or penalties. And this is even if you're over the income limits, which again, if you're making over $500,000 a year, you are going to be clearly over that limit there. But that's a really nice benefit. In fact, actually, for 2024, you can actually put in up to, I had it written down here, $66,000 per year if you're under 50, and I think the number is $73,500 if you're over the age of 50. So those are some really big numbers, and how those numbers are basically calculated there is it's the amount of your regular either pre-tax traditional or after-tax Roth contributions, which if you're over 50 can be up to $30,500 when you add in the catch-up provision, and then any match that you may be getting, and then that difference between that amount of contribution and that $73,500, you can actually contribute to that after-tax account. Now, I will preface it with this, is that not all 401k plans have it, but we have been seeing, according to a lot of research and studies, that about 40% of 401k plans offer this after-tax savings option. There also may be some other restrictions to it as well. So even if you have that ability to maybe put an extra $30,000 into one of those accounts, your individual plan may limit you to maybe 10% or 15% of your income. So there may be some restrictions to that. Another one is, and sometimes people call this the mega backdoor Roth, if you've ever heard that terminology there. I just call it the after-tax to Roth contribution strategy. But you can do a regular backdoor Roth as well. So if you don't have any existing IRA accounts, and if you do, it complicates it quite a bit. You don't want to do it if you have existing IRAs because of something called the pro rata rules. But if you don't have any existing IRA accounts, you can do a non-deductible contribution to your traditional IRA account up to the either the $7,000 or the $8,000 contribution limit, $8,000 if you're over the age of 50, with that extra catch-up there, and then you can immediately convert that over to a Roth IRA account. So it's a backdoor way to get money into a Roth IRA account. And even if you have, let's say, an IRA account, and that may kind of disqualify you based on those pro rata rules, but your spouse maybe doesn't have an IRA account, you could do it for them, but you wouldn't be able to do it for you. So it is individually, basically, it's based on an individual basis there to be able to do that. Another strategy that we're going to maybe look at as well, especially when we're talking about at retirement and maybe some of those lower tax years early, to extend that, another strategy could be to delay taking your Social Security benefits. And that could have a twofold improvement. Number one is, of course, if you delay taking Social Security benefits, there's an increase in the amount that you would get from Social Security up to the age of 70 is the latest you can delay that and still grow that. You get a really nice increase every year. So not only are you going to get a bigger amount that you're going to get, and depending on how long you live, it usually ends up being a pretty nice long-term benefit, but you also are keeping those tax years a little bit lower for a while, and that may allow you to do some more conversions there. So let's hop over into our financial planning software here, and let's take a look at a couple of things here when it comes to just kind of mapping this out. So one of the things that our software does, and there's probably other software out there that does this, and we do this through the Money Evolution Plan, which is our high-level comprehensive financial plans that we do one-on-one with clients. We can get a very good picture of what our future tax rates are going to look like. And so we can see here just really quickly visually, without implementing any of these strategies and things, exactly what I was talking about, where we've got some low tax years. And I didn't just really create this scenario just so I could have a lot of these things in there, but this is really pretty typical because if you think about it, if you retire at age 60, you're not even going to be eligible for Social Security yet. Even if you have a pension, it's probably not going to be anywhere close to the amount of income that you were making while you were working. And so for many people, you do have some years between the time you retire and maybe by the time Social Security kicks in, or maybe that entire time period before your required minimum distributions kick in, where you're going to be in these lower tax years there. And so this individual in this hypothetical client does have some of those low tax years. But the other thing we can see here too is exactly what we were talking about, where we've got this higher income tax bracket here, 32%. This is assuming inside of our software that we're going to revert back to the old tax tables with that adjustment for inflation. So basically the 32% becomes the 33%. And then we can kind of roll through time here and see that 10% bracket, which is what it's going to be projected to be in the early part of retirement. And then even while Social Security kicks in, it's really only about 15%, and it jumps up to 25%. But then we can see by the time they're both getting their required minimum distributions, that tax bracket jumps back up to 33%. So this is just basically accounting for the reversion back to the old 2017 tax tables before the Tax Cuts and Jobs Act rate went into effect, but not any new tax legislation, because we obviously don't know what that's going to be. And it could very well be possible that with all of our government debt, that we get future tax increases down the road, especially for maybe those higher income tax brackets. And that's something we definitely want to think about there. A couple of other things that we looked at here as an assumption for this individual. This individual does have some money saved up in non-retirement accounts, and they also built out a really nice dividend portfolio too. So we've accounted for that here as part of the way to supplement some of their cash flow needs for one part, but also, again, those are those tax preference items, and so those are things that aren't necessarily going to go into the tax bracket for getting you up into the next marginal bracket. And then I'm going to just look at, we just put in some Roth conversions, and this was just a really simple grouping here, and basically said, okay, we're going to take advantage of taking some tax deductions right now while our income tax bracket's high, in the hopes that once we retire, we go into that lower tax bracket, that we're going to be able to shift a lot of that money out of those tax deferred categories and then move it over to Roth and pay taxes at a lower tax bracket. That's exactly what we did here. So we just told the plan to fill up that tax bracket, so it's going to give us a pretty good idea of what that is, about $300,000 roughly per year. This does show them going into the 33% tax bracket. There's probably a little bit of additional tweaking here, but you can see they're not into that bracket by very much, just barely into that 33%. So there's just a little minor adjustment here to the software. But then what we see later on is that we've brought down their long-term tax bracket from 33% down to 15, 25, and it does hit 28% later on. And we can look at another report here too, where we see what the required minimum distribution is. So in this quick example here, this saved them over $1 million in taxes over their lifetime, so a very significant amount. And then because of those tax savings, we also saw an increase to the total portfolio value at the end of their plan, at the end of age 95, basically there. So $1,457,000. So this is fairly similar to what I did in another video called the Roth Strategies Case Study. We'll put a link down in the description below if you want to check that out. I think it's a little bit more in depth, and it's more focused on some of the software and how we do that, and the different changes and how we kind of stack different changes on top of one another here. But I wanted to just kind of show you what that looked like and what the benefit could be for just managing that tax bracket and really not just kind of guessing at it or maybe doing what your coworker did, but really putting it together for yourself. So you say, okay, this is where we're at with my tax bracket today, and this is where we think it's going to be in the future. So if we think about this, just to kind of expand it a little bit more, and we say, okay, here's an individual couple making $500,000 per year. They're in that 32% tax bracket today. But we have a lot of clients that are still doing very well, but their income might be maybe in the high threes or the low fours. And so that presents a little bit different opportunity that we may want to do more Roth contributions for somebody like that, because there's still room in that 24% tax bracket, because ultimately then, they're going to be in a 32 or 33% tax bracket, maybe in a couple of years if they're still working when those tax laws revert. So it's going to depend a lot on your individual situation and where you're at. But again, kind of going back to what we had up here on the board, just the overall strategies. And so basically looking at where you're contributing, that would be number one, and looking at how you can take advantage of that and do a little bit of tax arbitrage. Looking at the investments that you have and choosing investments that aren't going to hopefully be as big of a contributor to your income tax base. So focusing on investments that have long-term capital gains instead of short-term capital gains, or dividend income, a qualified dividend to be more in particular there. Be thinking about that. And then looking at the balance between those three buckets. And if you do have the ability to do any shifting here, basically taking advantage of something like mega backdoor Roth with that after-tax account can really help you to put a lot more money in there. And even if you said, hey, you know what, I've got enough money for retirement, I don't really need to save any more money, that's okay. But if you can put another $30,000 in a Roth IRA account, and even if you take the $30,000 out of your non-retirement account to do that effectively, you're still coming out ahead. You're coming out way ahead because you're doing actually a tax category shift, going from something that's a lot less tax efficient to something that's a lot more tax efficient. Actually goes all the way over here to the Roth is what that does. Take a look at that. The regular backdoor Roth. So that's if you don't have any IRA accounts, you can do that. You can contribute to a traditional and then immediately convert it to a Roth. And then looking at those low tax years, delay Social Security, and then the Roth conversions in early retirement, and really kind of taking advantage of that tax bracket, whatever that is, that's going to smooth that out the best over the life of your plan. So again, if you want to learn more about what we do, check out some of the links down in the description below. Hope this has been helpful as far as getting some tax strategies together for people who are in some of those upper income tax brackets. Thanks, and I'll see you back in my next video.